Good afternoon, everyone, and welcome to this panel. My name is Juan Savino. I'm Vicepresident at Lexington Partners. First of all, I would like to thank ColCapital for sponsor year after year. I'm here today with a group of very distinguished speakers. We have three international investors that are going to be talking about their asset allocation decision-making process and how they implement this in their own firms. This is of high relevance for the Colombian market. As you may know, last year, the Ministry of Finance in Colombia published a reform of the investment regime. So Colombia is now moving from a regime that was based on investment limits toward a more flexible approach that it's based on risk management and effective risk management, and it relies upon their boards of directors and investment committees. So the experiences from these three international investors are key to adapt the best practices to the local market, and we are going to be reviewing that during this session. This conversation will continue in the next session, where my colleague José Sosa El Valle is going to be speaking with representatives from Porvenir, Protección, Colfondos, and Scandia, the four local AFPs, to talk a little bit more about how they are implementing these new strategies in the local market. Having said that, I'd like to welcome the panelists, and if you could introduce yourselves very briefly, your firms and your alternative investment program, that would be very helpful. David, you want to start?
Sure, thank you, Juan. Thanks, ColCapital. David Simpson, I'm an investment officer at Lacera, which is the Los Angeles County Employees Retirement Association. I've been with Lacera for about 8 years. Prior to that, I worked for a family office in Dubai, overseas, and I also worked with the city and county of San Francisco. And then most of my career prior to that was really more on the corporate finance side, working with Charles Schwab up in the Bay Area. So Lacera is a $65 billion public pension plan serving 165,000 retired and active workers in the county. In terms of private equity, we've got about a 10% allocation to private equity. We've actually been investing in the asset class since 1986. Currently, our net asset value stands at about $8 billion, with another $5 billion in outstanding commitments. In terms of composition, we've got about 73% is U.S., 27% is international, and then of that, say, $8 billion, just under 10% is in emerging markets, very little frontier. And most of the exposure in emerging markets is China, which is about $436 million. And then Colombia is actually number 2, but a distant second at about $60 million. So it's kind of high level. That's me and Lacera.
Great. Jordi, do you want to continue?
Yeah, thanks for having me in the panel. Thank you all for the invitation. Jordi Tasias, I'm at the CDPQ. CDPQ is Caisse de dépôt et placement de Québec. We manage, workers' money for the province of Quebec, with the second largest pension fund in Canada. I'm based in Mexico, and I'm managing director. I joined CDPQ 3 years ago now, managing director. I oversee Mexico and LatAm ex-Brazil. Also heading the private equity team for LatAm. Couple of numbers. CDPQ manages like close to $300,000 billion worldwide. Different asset classes, listed equities, fixed income, private equity, real estate, and infrastructure being the main asset classes. We still have the main part of our portfolio is coming from listed equities, the traditional kind of assets, fixed income and equities. But over the last few years, we've been growing significantly in real assets investment, and also in emerging markets, where today our exposure is around 15% of our total asset base. In LatAm, we have investments in the area of 50 billion, all asset classes, $50 billion. And our main growth focus for the region has been, and it is, the infrastructure investments. So we can go into detail later on.
Great. Agustín?
Yeah, thanks, Juan, and thanks, ColCapital. So I'm the head of investment of Santa Lucía Seguros. Santa Lucía Seguros is a family-owned Spanish insurance business. We are active in both the life and property and casualty business, and Santa Lucía was founded in 1922. So next year is we celebrate 1 century, right? We have close to 14 billion in US dollar in asset under management, of which around 4% is in alternative investment, mainly private assets, managed through funds and mandates, and around 6% is in real estate. In our allocation of private assets, at the beginning we were favoring more like private debt and infrastructure funds until maybe last couple of years when we have increased our exposure or allocation to primary and secondary private equity. These changes with COVID-19 where we focus more in direct lending and opportunities in the private credit market. And by geography, our main geography is Europe, mainly in debt, infra, and real estate. And this is because we don't want to have more or a lot of currency risk because of the charge of capital. And in these asset classes, we have more contractual returns. And then in private equity, our approach is more global. So
great. Excellent. And just to recap, this new investment regime I was mentioning applies not only to pension fund managers, but also to insurance companies. So Agustin's international experience is also of great value. David, Agustin mentioned a little bit more about how the private equity and alternative investment program evolved over time. Would you like to give us your approach from Lacera's?
Sure, happy to do that. And it has changed a couple of times. I think when I first arrived in about 2012, I think one of the big shifts was moving a bit out of the larger buyout asset class and more into, say, middle markets on the private equity side. So just from a perspective of where we were kind of targeting in terms of what types of managers, we continue to try and do more internationally. And in 2018, really kind of following up maybe a little bit on Agustin's comments, Lacera adopted what we call a functional asset allocation strategy. So prior to, say, 2018, private equity included some debt strategies, as well as some energy, natural resources, a few things that didn't quite have other buckets or asset classes to go to. In 2018, with the functional asset allocation construct rollout, we created a real assets category and really moved towards aligning the investments, I think, more accurately in particular buckets. So for instance, our distressed credit is now in a credit strategy and is really kind of part of that vertical. Energy and natural resources is now part of a real assets bucket, which we didn't have up until 3 years ago. And then, most recently, and really kind of stepping back, we do an annual structure review, although now we've moved to every 2 years with our board of investments, and staff works with a consultant. We propose an annual commitment target pace meant to maintain our exposure at, say, 10% plus or minus about 300 basis points. So for 2021, our target is 1.6 billion a year, and that'll probably encompass 12 to 15 investments. What really has changed over the last couple of years is, I think, bringing more of the investment decision-making in-house, specifically as it pertains to like co-investments and secondaries. So previously we had intermediaries really doing that, and we were having kind of knowledge transfer. As the team has evolved, and I think the board's confidence in the team to bring those things in-house and manage them in-house, we've done more of that. So, over the last 2 years, we've done about 20 co-investments in-house, deployed about $500 million, and done a number of GP-led secondaries. So I think those are kind of the main things. But I think just from a structural standpoint, it's really focuses on the structure review, having strong alignment of interest between, what staff is doing with the board and the consultant, and then really executing against that strategy.
Great. Jordi, do you want to comment on the evolution of your alternative investment program?
Yeah, I think basically similarly to what David was commenting, and also related to the scale, of the assets. This strategy has been evolving, moving from more kind of traditional investment areas towards more direct, real assets investment. And today, if you add our real assets portfolio plus private equity, it goes up to 1/3 of our portfolio, and this has been gaining space. Also, I think, and this is also in our strategy, we serve like 40 clients in Quebec. It's contributors we have, and so each one of them have different characteristics. In terms of what kind of workers or profile. Even we have some insurance companies with different profiles, and so we adapt our portfolio to each of their strategies, and that also seeking for higher returns, and together with the gaining scale has allowed us to develop, I think, the capabilities to go into the alternative market space. I think this is a trend that it will continue. Again, seeking higher returns and balancing the portfolio. And just it's also relevant to mention that 90% of our investments are directly managed. Our portfolio that's been also progressive change in our strategy, and very, very linked to the size of the portfolio. And I think this is for the region is something that we're seeing in local pension funds as they have more assets under management. They are able to have better or larger teams to attend these more kind of demanding areas of investment. So that's a summary of what we've seen over the last few years.
Great, and I think that this new regulation contemplates pension fund managers looking into more co-investment, as David mentioned, and also direct type of investment. So, David, I was curious about how Lacera works internally, and what's the role of the board of directors when it comes to this asset allocation process internally.
Yeah, so the board of investments, I think, is really having kind of a governance and oversight role. In fact, their roles and responsibilities are specifically stated in our objectives, policies, and procedures documents. And I actually think our structure review and our OPP was shared with ColCapital. So I think that's in kind of that depository of different kind of resources for attendees. But in terms of specific responsibilities of the board, it's around reviewing and approving the OPP, the annual investment plan, reviewing performance. And they do review and approve primary fund investments and any exceptions or waivers to the guidelines. So, currently with new investments or re-ups that don't meet certain criteria, those will go in front of our board in a closed session environment, and we'll advocate the merits and discuss the concerns and issues we have, and ultimately they'll make a determination. Again, I would say their real function is around oversight and guidance, and really I think affirming that the processes have been properly undertaken. So, and I say that as opposed to kind of getting in the weeds and meeting managers within with a role of basically doing what we do in terms of analyzing and recommending. So I think there's a clear delineation between what the board's role is, what staff's role is. And the board does hire and review the performance of our consultant as well. And our consultant has an independent role. So, if I'm analyzing an investment opportunity, we have Lacera's team doing their thing. Our consultant is currently Stepstone. They're doing their thing. We meet periodically. And then If there's concurrence, we would progress and eventually bring recommendations to the Board of Investments. But the idea, I think, is ultimately you have 3 distinct bodies, and hopefully that eliminates mistakes and results in the best ideas and thinking advancing through the kind of diverse thinking of those 3 bodies.
Great. And Agustín, in your case, your program is a bit younger than Lacera. So what's your approach to this investment decision process within the Santa Lucía?
Yeah, we can think about the decision-making process in an insurance company as in the same terms as a bank, right? Because, and what I mean with that is that we have like 3 edges of a triangle. One is for sure market risk, and we can call it a counterparty risk or credit default risk. The other one is expected return. This is the second one. And the third one is the capital charge that you have. And this is the big difference and a big constraint in the asset allocation for an insurance company. And that's new, also something I will say new in Europe, because it's something from 2016. Before that, we have something very similar to what Colombia has with a load or a suitable investment, and we move to another framework in which you have to support your investment with capital, right? So this is the ability of the insurance company to invest in a wide variety of asset classes and change the asset allocation depends on the capital position. The stronger the capital base, the more freedom you have to increase your exposure to risky assets. So as an example, for the European average portfolio of the insurance company, that's the latest data from the regulator, 65% is fixed income, right? Split in half government bonds and half corporate bonds. And 20% is equity. And in this 20% equity, around 2/3 is unlisted equity, and the rest is cash, real estate, mortgage loans. So changing this composition from fixed income to, for example, alternative investment, private equity, private debt, it depends only on two options. So you have a lower capital charge for certain investment or certain type of investment, as for example, private equity, and they are changing that. Or infrastructure project, and they are changing that. Or the second option is organic generation of capital. So having this in mind, the investment team need to have like 2 budgets in their investment decision process. One is the market risk budget, the default, for example, in fixed income, and the other one is the capital consumption budget. And in our firm, for example, both this market risk and this capital consumption, this capital budget are subject to the risk appetite framework of the company, which is at the end of the process decided by the board of directors. So this risk appetite includes, for example, market risk metrics like ratings in a portfolio of fixed income, geography in listed equities, or these different sub-asset classes in alternative investment, but also includes the capital metrics such the ratio that we want to have, or the desired ratio that we want to have over our regulatory capital. So the process at the end is we that are the investment team elaborate a proposal about our asset class allocation. This proposal is not a fixed number for each asset class, but a maximum and minimum weight for each asset class. And as some mentioned, it depends on the liabilities that are behind each business line. Each business line has its own asset allocation, and then the proposal is sent to the risk and compliance division, and they are the ones that stress test the portfolio and the riskiest possible portfolio of taking into consideration the maximum ranges, and if this is inside the risk policy of the company, the risk appetite of the company. And then is when we ask for the approval of the board of directors and they challenge, review it, or change everything if they think is appropriate.
So, and different from David, in your case, you don't work with external consultants or any firm?
Right now, we are in a much younger position, and our path is we will be following the same path, but maybe in the next year, because I think, and we must understand that in Spain, we are a bit slower embracing this new framework because of our high yielding government bond portfolios, because of the peripheral crisis in 2011 and 2012. So in Spain, we are making this process much rapidly, but in the last, I will say 3 to 4 years. Okay. So we are in a very long process, and we are at the beginning.
And Jordi, in your case, I'd like to also not only ask you about the main government decision bodies, but also in terms of your risk management approach, that I think it's very, very unique in a sense. So could you comment on that?
Yeah, sure. Basically, we have, as I was saying, this allocation strategy is coming from our depositors, let's say, and then it goes down to 3-4 year plans on by asset class, which is updated on a yearly basis. And then in terms of from a risk perspective, I think the way we define it is like we have like three lines of defense, right? First, the business units are the ones responsible for the risk management, assessing the transactions through committees and, the investment criteria. Then you have a kind of the support and risk monitoring, which is transversal. We have compliance units, governance, risk team, research, which is normally used across our classes. So that's kind of the second line. And then we have the board that from a risk management perspective, what they make sure is that the processes work well, right? So that's how we define the risk management process in our organization. Then you can imagine a number of different subgroups, dealing with ESG, dealing with geopolitical, with all the needed kind of analysis that we have in-house. Obviously, we also use external consultants to define strategies to pursue or to open new, initiatives. I think I can think now of, assessing markets for private debt, these kind of examples. But yeah, that would be kind of summarizing the 3 level of defense that the way we define it internally. And I think a big part of the responsibility is in the business units of each asset class, through the with the support of the transversal areas, and then with the supervision of the board in terms of processes and making sure that the decision making works in the right way.
Hey Juan, I might also add, just in terms of risk management for, say, the private equity portfolio at Lacera, I think diversification is really critical, and we think about diversification not just from geography, but from vintage year, from sector, as well as manager. So in terms of overall exposure to a specific manager, and I think one of our first sections in our recommendations is really around portfolio fit. So I think any pension plan, in Colombia or anywhere, really starting to think about portfolio construction, I think that's the first kind of risk mitigant is, those kind of guardrails on exposures.
Right. Yeah. And in your case, Jordi, so this risk management process, it's overall, it's not based on specific strategies, right? So, and then with each strategy you work.
You have a kind of a transversal, units that oversees the whole thing. But then in each asset class, you have their own committees, that obviously have participants, of these transversal areas and from other asset classes. So that's so it's quite homogeneous, but specific by asset class at the same time.
And just to complement on that, it's what David was mentioning. The Colombian pension fund managers have been investing in private equity in the asset class for a long time, right? It's probably 10 to 12 years. So in a way, I think that they've developed programs and diversification by vintage, by strategies. It's now more about moving from this this investment regime based on limits towards something a bit more flexible and reliant on risk management internally, with their own boards of directors, their investment committee. So I think that's kind of the process they are undertaking.
And I think it's kind of a very natural evolution. Also seeing the size of the growth they've been seeing in assets under management. Yeah. So the way we see it, and we've been partnering with some of the local pension funds in different countries in LatAm, and we see that evolution. And I think the region has the specificities. Doing private equity in the region, at some point may be a little bit more challenging, but then you have a huge market space in infrastructure, so that all this goes with, David comments on the diversification and asset allocation based on the geography where you want to invest. For example, in our case, clearly the region is seen as a good opportunity in terms of infrastructure, given the nature of the market. That's this evolution. I think we're seeing it very natural as they gain in scale. They will end up in schemes very similar to ours. It's just, if I may simplify this, it's a matter of scale. As you have the resources, you can go more into direct alternative, this kind of market spaces.
No, perfect. And taking Jordi's comment and also transitioning to the next session as well, right? What are some of the best practices that you, from your own internal processes, would suggest open to discussion in the next session, regarding things that Colombian pension fund managers and insurance companies could adopt to this new regulation that is changing a little bit how they approach the asset class?
I think it's about asset allocation, right strategy in terms of whether you defining your co-investment strategies, asset class, and type of let's say portfolio you want to cover with these investments. I think in terms of governance and capability, I think they are doing the work. I mean, it's I think there's even ourselves are learning from other organizations and all that, but maybe a robust strategy in terms of asset allocation, and probably transitioning from managers to direct investment. It may be a challenge, and on that process, having a balanced strategy in both buckets. I think it's something that could be one of the key focus areas in terms of defining strategies.
Perfect. David, you want to comment?
Sure. One of the things that Jordi said that I think really kind of resonates is around learning, and I think one of the challenges of any kind of, especially as larger kind of somewhat political, bureaucratic organization, is how do you continue to be a learning organization and be open to ideas from other sources and enable staff to continue to grow and evolve. I think it's very easy for a lot of organizations to become very static and set in their ways. And I think especially as we've seen disruptive technologies and this move towards the information age really taking hold, obviously, especially over the past year, that ability to really adapt and empower employees to grow and try different things, I think is really critical. I think, certainly governance oversight we talked about. I also think of the board's role as leaders, and by that, I think about things like ESG, diversity and inclusion, really kind of representing the values, but also ensuring that in our investment practices that we're actually incorporating those values into what we're doing. So if you looked at our process, and now we have scorecards for our managers, and they are evaluated not just on performance, but really on things like how are they evolving in terms of implementing ESG policies and strategies, not only at their firms but at their portfolio companies. Certainly, things around transparency and reporting are really important. And we continue, I think, like all limited partners and investors, how can we bring costs down, still be fair to our partners, but really as fiduciaries to our plans, our goals are always around, generating, I think, value for the dollars invested, and making sure that we're not, as much as we all love GPs, not making them like ridiculously wealthy, without, really kind of the plans benefiting from those profits. So I think really kind of striking that balance. So I think, those are some of the things that I think about.
And we are learning organizations, as they were saying, all these new trends on ESG, tech, all this is also new for us. So it's not that we know, that we can explain people how to do it. It's for us, it's also a process. And I think the big difference could be what I was saying, and again, oversimplifying here, that it's a matter of size. At the end of the day, when you have more resources that you can invest in your own capabilities. So sizing that, it's crucial, I think, and saying, okay, what can I do with what I have, and having a clear scope that goes with your capabilities. When I compare myself with other funds that are twice my size, probably we have also differences there. So where can I go with what I have in terms of all these aspects? I think it's also critical. If you overestimate your capacity, then you're assuming additional risk. On the other hand, if you go below that, so I think you're missing an opportunity. So for me, that it's one of the most difficult probably things, but at the same time, a focused area. Being very, very aware of, as we do, our own capabilities. For example, in private equity, we are minorities investors. And that's for a reason. It's part of our strategy and our nature of investment, and that responds to probably, among others, so that we need very strong partners in our investments, right? There are other private equity firms that they go for majority, and they have other different skill set. So I think that internal analysis and defining and using that to define your strategy is I think one of the keys. Positioning yourself according to your real capabilities. I think it's our day to day. So,
Agustín, do you want to comment from your experience?
Yeah, I just maybe the only thing I can add is to position the board with the independence, with the capabilities of the people that integrate the board, where you want to go. So if you want to change your asset allocation, and you need to increase your asset allocation in alternative investment, or maybe in infrastructure, you need to have people in the board of directors that knows the matter, that are independent, that they can challenge and take the right decision, right? And then this is a process for I think for every this is a never-ending process for every company, for every pension fund, and as I mentioned, in Spain we are changing all the asset allocation because of these negative interest rates, and we need the help and the support from the board of directors, and that means having a good composition. So that's maybe the only thing that I can add to the things that David and Jordi said.
One other thing that's kind of interesting as we talk about board evolution and something I've admired about our board is their willingness to get outside help to help them become better, kind of decision makers and process. And I think that's really a strength of the organization. I think something that's still developing is being willing to get external help and say, we need help going from point A to point B. And sometimes that outside perspective can help, number one, facilitate conversations that are really authentic and bring up some challenging issues and allow people to ask tough questions, but have kind of a safe environment to do that ultimately leads towards, kind of growth and evolution of the board that allows them to be more effective in their roles as well. So I think that, again, it gets back to kind of the learning organization and culture. I think as a boards, their roles in helping set the tone is really critical, and that willingness to do that kind of self-reflection is and kind of indicative of that. So, in terms of, if I'm building the boards and helping them, those are, I think, great lessons to really kind of espouse and bring aboard as well.
So before we finish, I'd like to ask the panelists if you had any comment or advice for our next session for the institutional investors in Colombia. Both pension funds and insurance companies are actually working on this as we speak. Yeah.
Sorry.
Go ahead.
One of the things that our board does that I think really helps provide a lot of perspective on what's going on around the world is they actually travel to a lot of conferences and they do meet managers in different markets. So, staff has been on due diligence trips and at conferences, and a number of board members, whether it's China, India, Dubai, Africa, South America. And I think especially for, say, our US boards to actually experience the markets and where the capital is being deployed provides just really kind of a great perspective and enables them to have, I think, a greater appreciation for, where the money's being deployed, the quality and quantity of managers in those markets, the opportunities that are taking place in terms of really, we talk about a lot of the faster growing GDPs or in many of the emerging markets, but really to be on the ground and see that as opposed to, maybe being a little bit xenophobic or not willing to spend money to travel. I just think it, again, broadens horizons, and I think that makes our plan stronger.
Maybe an obvious one, and I would close with this one, is, I think for all of us, it's valid, and, making sure that internal processes respond to the new market challenges, new investment scheme. It's what I guess it's the obvious one, but is where I would put all my efforts to make sure that we preserve capital, long-term capital.
Right. So, Agustín, do you want to comment?
I think I don't have any more to say that.
Great. So I would like to thank you for your time, your insights. This conversation, as I said, will continue in the next session. So with this, we close the panel, and thank you very much for attending.
Thank you.
Thank you.
Thank you, Juan.